One of the most confusing topics for beginners is timeframes. Which timeframe should you trade? In this video, we'll explain timeframes simply and help you avoid common beginner mistakes. A timeframe shows how much time each candle represents. For example, 1 minute, 1 hour, or 1 day. Lower timeframes show more detail. Higher timeframes show the bigger picture. A 1-minute chart moves very fast. A daily chart moves much slower. Neither is better or worse by default. They just serve different purposes. Beginners often make one big mistake. They switch timeframes constantly. This creates confusion and bad decisions. Lower timeframes have more noise. Price moves randomly more often. Higher timeframes are more reliable. They show stronger trends and key levels. This is why many beginners should start higher, such as the 1-hour or 4-hour chart. These timeframes reduce emotional trading and give you more time to think. Professional traders use multiple timeframes. This is called multi-timeframe analysis. Higher timeframes show direction. Lower timeframes help with entries. But beginners should keep it simple. One main timeframe is enough at first. Consistency matters more than speed. The best timeframe is the one you can follow calmly, without stress or rushing. Timeframes don't change the market. They only change how you see it. Quick recap. Lower timeframes show more noise. Higher timeframes show clearer structure. Beginners should start higher and stay consistent. Choose clarity over excitement. In the next video, we'll cover which timeframe is best for beginners.